Welcome to the Savvy Shopkeeper Retail Podcast. I'm your host, Kathy Cruz. I'm a former brick-and-mortar store owner turned retail expert who is passionate about entrepreneurship and has experienced the highs and lows of running a retail business. Whether you're a seasoned retail veteran or an aspiring store owner, consider me your guide on this store owning journey. If you're looking to run a profitable and growing business that doesn't drain you, follow my 6 stages of shopkeeping and subscribe to this show. Join me for a journey of continuous learning where protecting your mind, maximizing profit, and determining your own schedule are a priority. Get ready to work smarter, profit more, and grow your retail business. Welcome to episode 247 of the Savvy Shopkeeper Retail Podcast. Why brick-and-mortar retailers shouldn't avoid profit because of taxes. I'm your host, Kathy Cruz. So I feel like, before I get started on the episode, I just started to dig into personal stuff. I feel like I haven't recorded a podcast episode in a while. My team and I, we've started working further ahead than we used to, and it's been really nice. And there was a time where I think I recorded at least like 2, 3, or 4 episodes just to get us ahead, and it feels really good. So here I am recording today, and I feel like it's been a long time since I've recorded. And in my mind, it feels like it's been a long time since I've talked to you. Even though I can't see you or hear you, I do visualize when I do these episodes that I'm talking to a bunch of store owners or one store owner. And I guess that's really helpful just to remind myself, of course, like who I'm speaking with. But it feels like we haven't had a conversation in a long time. So I'm happy to be back, even though it probably feels like I haven't had a break. So today we're diving into a topic that I think we need to talk about. It's the fear of making more profit because of taxes. Now, I personally do not have this. I don't even think about this. For me, it's profit and pay is my goal. But I know for a lot of you, there is this fear around it. I know it because of conversations that I've had. So if you've ever thought, I don't want to make too much money because I'll just end up paying more in taxes, or if you've had someone in your life tell you that, it's not unusual. It happens probably more than you think. On the flip of that, you might hear some conflicting information on the topic. Where people are telling you, like me, like, I don't think it's necessarily a bad thing to make more profit and to pay myself more. You might be thinking, but Kathy says I should pay myself. Now, I don't like to should people, but that is one message that I'm pretty consistent about because I think it's really important. And you can probably visit multiple podcast episodes in the past that I've recorded on the topic. Anyhow, if any of these fears or this messaging that you've been receiving to not profit more because you'll pay taxes, this episode is for you. But even if it isn't the case, I think it's still really helpful to listen to this episode because I'm going to share some stories. They're made up stories. They're not real examples, but I think that the storytelling is always really helpful. We're going to unpack why or when avoiding profit can actually be a bad financial strategy, how it can actually hurt your business, and what to do instead. And as always, I will share the examples to help illustrate these points. Of course, I want to add a disclaimer that I am not a certified financial expert. I did have my business advisor take a peek at this episode just to ensure that I was sharing accurate information. So I want to give a shout out to Howard for taking some time to review my script. I really appreciate it. But the important thing to note here is that you need to ask your CPA or financial advisor and or bookkeeper for clarification on any of this as it pertains to your business and financial situation. All right, let's go ahead and get started. Why do retailers fear taxes? It's completely understandable. Taxes can feel overwhelming. I personally hate them. Hate is a strong word, but yeah, it's my least favorite part of running a business. It's not the financials, it's not the metrics, it's not the boring system stuff. It's taxes. So I get it. Especially if you're a small shop owner doing it all yourself or relying on a bookkeeper who's just that, a bookkeeper, not quite a a chief financial officer. Most store and small business owners don't have the budget for a CFO, which means we have to learn how to be our own CFO. And then, of course, seek other experts in our business world to support that. When it comes to paying taxes, you may have heard myths like making more money will push me into a higher tax bracket and I'll lose money. Or maybe I should write off as much as possible to avoid taxes, even if that means unnecessary spending. And the last one, it's better to show lower profits to the IRS so I don't owe much. But here's the truth, taxes are just a percentage of your profit, and keeping more money even after taxes is sometimes better than making less money. And I will explain all of this for those of you who are already telling me or thinking, Kathy, no, 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 I just want you to hear me out. So let's go ahead and break it down. One of the biggest misconceptions is about tax brackets. Many store owners think that if they earn more, they'll jump into a higher tax bracket and suddenly owe an insane amount of money. But that's not how it works. The U.S. tax system is progressive, which means you're only taxed at higher rates on the portion of income that falls into each bracket. So for example, if the first $40,000 of income is taxed at 12% and anything above that is taxed at 22%, that doesn't mean all of your income is taxed at 22%, just the portion that exceeds $40,000. So even if your store goes from making $60,000 to $80,000 in profit, you'll still keep most of that additional $20,000 after taxes. So let me share my first example. This is the gift shop owner who avoided profit. Let's talk about Sarah, who owns a small gift shop. She had a great holiday season and was on track to make $75,000 in profit, but someone warned her she'd owe more in taxes. Instead of reinvesting or saving, she bought unnecessary inventory just to get a tax write-off. And anyone in Master Shopkeepers right now, you all know that I would never recommend that. You buy inventory because you need the inventory because there's a demand in your store, not just to get a tax write-off. Number 2, upgraded her store fixtures even though she didn't need to. Number 3, gave big discounts at the end of the year to lower her taxable income. By doing this, she avoided extra taxes, but also wiped out her profit. The next year, when her slow season hit, she had no cash reserves and struggled to pay rent. Had she planned better, she could have 1, paid the taxes and still had a strong profit, 2, reinvested in strategic growth like better marketing or staff training, and 3, built up a financial cushion for slow months. Instead of fearing taxes, we should be shifting our mindset because profit is power. With profit, you can invest in new inventory that'll drive real sales, improve your in-store experience to attract more customers when that's needed, though, not just because you want to save on taxes. You can save for expansion or emergencies, and you can pay yourself and your team better. So if you're already worried about paying more taxes, I just want to add this little tidbit here that one smart way to handle taxes is to set aside a percentage of your profits. I want to make sure I emphasize a percentage of your profits. You can set that aside throughout the year rather than being surprised in April or not feeling prepared to pay that bill in April. This way you don't have to scramble when tax season hits. And in many cases, it's actually required to make estimated tax payments. So make sure you ask your CPA about this. I think as small business owners, in our minds, we go a whole year. Some of us, I know I did this at the beginning without knowing what would that tax bill look like at the end of the year. So saving 20 to 30%, I'm just going to mention that in a minute in this episode, but I may as well mention it now. Maybe saving 20 to 30% of monthly profit would help you or set you up for success when it comes to bill time. Okay, the next example I have is the jewelry store that thrived. Now let's look at Maria, who runs a boutique jewelry store. She too had a great year and expected a big tax bill. Instead of avoiding profit, she planned ahead by setting aside 25% of her extra earnings. She hired a part-time employee to improve customer service, and she launched a VIP loyalty program that increased repeat sales. By the end of the next year, her store's revenue had grown by 30%, and she was still profitable even after paying taxes. So the key difference here with the two examples is she saw taxes as a sign of growth and used her profits wisely. If you find yourself thinking, I don't want to make too much because of taxes, here's what you should do instead. One, aside from listen to this podcast episode, one, work with a tax professional and don't just talk to an accountant once a year. Have quarterly check-ins so you can plan ahead and take advantage of legitimate tax deductions. I'm going to add an extra bullet point here before I forget. And this is not to dismiss your partners or spouses. Please don't send them after me. But if they aren't fully involved in your business, if they aren't actual business partners or don't review your financials every month and they don't know the cash flow part of your business, please, by all means, have a conversation with them, but work with a tax professional for guidance. I think that's so incredibly important because I sometimes hear the spouse telling the actual business owner, ooh, don't make too much in profit. We're going to have to pay more in taxes. And then if you're wiping out all that potential profit in tax write-offs or in whatever it is that you're spending on, again, if I go back to that example, what was her name? I think it was Sarah. She ended up not having an emergency fund or a reserve fund for those times that she had slow months. Our spouses don't always know the details and the nuances and the peaks and valleys and the financial situations of our business. I think it's really important to get an additional set of eyes and other advice, especially from the tax professionals. This episode is brought to you by my new free resource, Valuable Data to Collect for Your Brick-and-Mortar Store. One of the questions I hear most often is, how is my business making money, but I'm not making money? I ran a profitable brick-and-mortar business from day one, and the reason why is because I used data to make decisions. In my new free guide, I'm sharing all the systems that I would set up and the data I would collect if I were to start a store from scratch again. Whether you're preparing to open or you've been open for years, it's never too late to start tracking. Visit savvyshopkeeper.com/data to get the guide. So where was I at? I was talking about what you should do instead of avoiding profit. The first one was work with a tax professional. The second one, reinvest strategically. Instead of spending just to avoid taxes, reinvest in areas that drive revenue. So improving your website or in-store experience, launching a marketing campaign, training your employees to sell more effectively. Those can get the needle moving forward. Number 3, use tax-advantaged accounts. So consider putting extra profits into one, for sure, which isn't necessarily a tax-advantaged account, but it is an advantage. Put it into a business emergency fund, reserve account, whatever you want to call it, to prepare for those slower months. Again, this might be number 2 to paying yourself, is having that reserve account. And then, of course, if you have even more to spare than a retirement account like a SEP IRA or a solo 401k, go ahead and invest in that. This reduces taxable income while helping you save for the future. And then number 4, I've already said this a couple times, set aside a percentage for taxes. A good rule of thumb is to set aside 20 to 30% of your profit for taxes. That way, when it's time to pay, you're prepared. And then the last example I have is about the clothing boutique that took control. So Emma runs a boutique. A few years ago, she would panic every tax season because she never set money aside. But last year, she created that separate tax savings account and transferred 25% of her profits every month. She worked with an accountant to maximize smart deductions, and that means a CPA, a certified public accountant, that specializes in taxes. And then she used her profits to invest in better store displays and an online shop. Not only was she ready for tax season, but she also grew her business in a way that set her up for future success. All this to say, some tax advice just gets passed down from generation to generation, and it isn't the best advice. In fact, some of the advice you hear can be causing you to limit your business and your potential. And I have some examples that I want to share next. Before I share those strategies, I just want to say that I have another podcast in queue on the topic of systemic and programmed thinking for women in retail. So I won't go down that rabbit hole right now, but please know that that's coming. Okay, so here are the limits that result from not so great advice. Limits. One, it can limit your business growth potential. Purposefully limiting profits on paper reduces the amount of retained earnings available for scaling the business or pursuing larger investments. Lenders or investors look for healthy profits when deciding to fund or partner with a business. So that's one place where people are telling you save on taxes, save on taxes. But if you have a plan for big growth in the future or expanding or opening other locations and you go to a bank for funding, this is going to limit you. So it's so important to share that with you. I understand the tax savings and I'm all for tax savings, but be careful about the long-term results or the long-term damage that can come from that. Two, it can lower your business valuation. So, along the same lines, when businesses plan for an eventual sale or seek outside investment, reduced profitability will directly affect your valuation. Buyers typically base valuation metrics on profitability. So, just make sure that you keep that in mind. Number three, it'll limit your access to financing. So, kind of similar to one, but bank and lenders assess profitability when deciding whether to grant loans or credit lines. Low profits may and most likely will reduce access to growth capital or lead to higher interest rates on loans due to perceived risks. You see where I'm going here? Number four, it can create missed opportunities for wealth. Some entrepreneurs prioritize reinvesting to avoid taxes, but forget that higher profits could also contribute to personal wealth building. And then number five, potential IRS scrutiny. Intentionally underreporting or overly minimizing profit without justifiable business expenses can lead to audits or penalties, and no one wants that, right? So entrepreneurs have to walk a fine line. On one hand, you want to minimize taxes because of course, who doesn't, right? But on the other, you need to show enough profit to keep growing and to be seen as a legit, healthy business, especially if you want to get funding, especially if you want to grow, especially if you have big goals and plans. Working with a tax advisor and a financial planner can be really, really helpful, especially if you want to achieve those goals. And if you want to achieve some strategic goals, like taking full advantage of deductions, but of course, not stretching so far that it hurts your business, look into ways to defer taxes instead of constantly trying to shrink your profits on paper, and then focus on building a strong, long-lasting business, not just cutting taxes every year. Ultimately, the decision depends on you, your long-term vision for the business, whether you prioritize short-term tax savings or long-term profitability and scalability. So here's the bottom line. Avoiding profit because of taxes shouldn't be a blanket one-size-fits-all strategy. And I often feel like that's just the sentiment. Like, oh, tell all the retail store owners not to profit too much. That's going to hurt you. Instead, focus on making your business more profitable, using tax strategies that benefit you, and reinvesting in your store in a smart way. Taxes are a part of success, whether we like it or not. And you all know how I feel about taxes already. Ugh, God, I do not like them. But remember, if you're paying more in taxes, it's because you're making more money. And I want to say this, it's not that I don't like taxes. I pay my tax bills. I don't have a problem paying it. It's all the questions that I have around it, right? Like I can see why people get stuck in taking the not so best advice, right? It alleviates the pain. If you're thinking, oh, I'm just not going to show any profit, you're going to make all these decisions on your own instead of booking the phone call with the CPA, instead of asking your bookkeeper for insight or asking them for advice. It's easier to avoid that pain by just getting rid of all that profit. Please don't do that. I have the hard conversations all the time. I'm still learning about taxes, and that means I have to ask questions and book the phone calls and send the emails and do all the things. Remember, if you're paying more in taxes, it's because you're making more money, and that is a good thing. If you found this podcast episode helpful, please share it with a retail business friend or leave me a rating and a review on Apple Podcasts. I really appreciate it. Or any podcast app that you listen to. I feel like years ago, the only place that you could leave a review was on Apple Podcasts, but I feel like you can actually do that now on a lot of other podcast apps. And you all listen on a variety of podcast apps, not just Apple. So maybe I just need to change that ask. Anyhow, when you do leave a review, I genuinely appreciate it. If you want to see the show notes to this episode or find links to anything I mentioned, you can visit my blog at savvyshopkeeper.com/episode 247. That's savvyshopkeeper.com/episode 247. I think for next week's episode, we're going to talk about doing a cost-benefit analysis of extending your stores. I've been talking so much about metrics in Master Shopkeepers, and I realized I haven't really been talking about them on the podcast. So next week, for those of you who love the metrics and who love like having a piece of data to make decisions about, this one's going to be for you. When does it make sense to extend your store hours? That'll happen in the next episode. I said next week's episode, but you all know I mean in 2 weeks. All right, it's time to wrap this up. Until the next episode, be savvy and boss up.